Hi guys, I hope you guys are doing well. I hope everyone's doing good in these trying financial times. I'm Kwasa and I'm an analyst at Fusion Forex. I want to talk about smart money concepts. Yeah, so when you talk about smart money concepts, basically we're just referring to how the smart money in the market trades. These are the more informed traders and just people with more information in the markets. So when you're studying the smart money concepts, we're going to be looking into the concepts of liquidity, market structure, and we'll have a honorable mention of Wyckoff. Yeah, so we can start off by defining Wyckoff's composite man. Wyckoff, he's an analyst, a technical analyst who was alive between the late 1800s to the early, I think 1930, yeah. And Wyckoff came up with the Wyckoff method, where he'd analyze the idea of composite man. So he'd take all the operations of the market and assume that it's one person behind the operations. And this paradigm helped him understand what the composite man would be doing in any given situation. This would later result in him figuring out market rotations and basically the anatomy of a price trend. So Wyckoff's composite man, directly off the book, the Dr. Richard Wyckoff course in stock market science and technique, there's a quotation. All the fluctuations in the market and in all various stocks should be studied as if they were a result of one man's operation. Let us call him the composite man, who in theory sits behind the scenes and manipulates the stocks to your disadvantage if you understand the game as he plays, and to your great profit if you do understand. Yeah, so Wyckoff advised retail traders to try and play the market game as the composite man played it. In short, you were meant to follow in the footprints of the composite man. So, smart money concepts, which is, in a sense, a modernized, a more efficient. Like there's been more iterations of the market to be studied for them to derive smart money concepts. But I'd say that there's quite an interrelation between smart money concepts and Wyckoff. So we can draw some of the parallels. And this come through, like when you see the composite man, he carefully executes his campaigns. It's always more informed money. The composite man isn't out here trying to lose. So when the composite man is in accumulation, which is when he's trying to buy up a share, or is in distribution, when he's trying to sell his shares, it's because of a certain reason. And it's very specific, and inevitably it pans out in his direction. That's the idea of the composite man being careful in his executions. Also, the footprint of the composite man cannot be hidden. So the composite man cannot hide his movements in the market. In a sense, you can think about the composite man as the large funds and the corporates and the banks, the institutional banks that deal. That's for FX. So the composite man can be that huge volume of money that's traded by these entities. And that huge volume of money, when the market's exposed to it, you'll have to see a movement. The footprint cannot be hidden, definitely. So yeah, traders find the footprint of the composite man and align to it. So there's a very strong parallel in Wyckoff and smart money concepts, where you wait for a footprint to show up. You wait for the markets to tell you that entirely this market is going to trend in this direction. And once you have that happening, you are aligned with the market. And that's when you place your trades and you, in essence, cut off the risk. The idea of Wyckoff and smart money concept is to cut off your risk when you're trying to trade. Let's go to the charts and have a look at the charts. Okay. So here I have the NZD USD. This is the weekly chart. So I'm just looking at the the overall price action for NZD/USD over the past 10 years or so. Yeah, that's what you can see in this chart. So I'm taking this into consideration. If you are a trader in these markets throughout this period, where do you think you'd likely to have wanted to participate in either buying or selling of this market? Well, simply, you'd probably want to be a seller in this region. Let me make that a bit more bold so that you can just see. Yeah, you'd likely want to be a seller in these regions, because from these regions, for weeks on end, you had movements going in your direction. So if you are a seller in this region, that wouldn't be a bad idea. That wouldn't be a bad setup. You'd probably be profitable, and you'd have a lot of risk off the table, since the market doesn't even go beyond this high, for example. You'd also want to be a market participant, maybe in these lows, a bit chaotic, but would make a nice setup. You'd also want to be a participant in these highs here. These highs would make a good sell region. Well, it's good to fantasize about these things and think about getting perfect market entries at any given moment, but what were people actively doing when the markets were here? This was in January, this was January of 2021, when actually the commodity currencies, I guess even the pound and the euro, they made highs, and that high, as it turned out to be a long-term high. So they made highs which were priced in as long-term highs. But the trading environment that was provided at this period, everyone was like, these currencies are definitely going to the moon. There was an idea of the crisis and everything inflating, and guys were thinking that these prices would overextend upwards. But the opposite has turned out to be true. But how would you be able to perceive that there's a change in the trend, and you could possibly capitalize in a new direction for your own profits? So that's the relevance. That's basically the relevance of the paradigm of smart money concepts. And for example, if we were to break this down a little more, what we want to study essentially is how the market makes a rotation. So the anatomy of this structure. And this structure, it's not necessarily forced onto the weekly time frame. You can use any time frame. And as long as the market is doing the same thing, it's going to leave a footprint that shows you how the money or the orders are accumulating. Okay, so basically, this last high, I'm going to take that as my point of interest. I'm going to dissect this last high and the short opportunity that came from that last high, and how, if you understood smart money concepts, you'd have been able to capitalize on this high. So the first idea of the markets is that there's normally trends. You can see generally from the region that we highlighted earlier, the first region we highlighted, we had a high and the market trended downwards into the COVID lows. These were the COVID lows. This happened during the lockdowns and the market crash. Yeah, so that was a low, and after that the market generally started trending upwards. So you take the basic characteristic of a trend. You know that an uptrend is made of higher highs and higher lows. A downtrend is made of lower highs and lower lows. So there's a sequence of higher highs and higher lows throughout this period, from this zone right here to the high that was formed here. The market throughout this period, you can see it formed, this was a lower high at the time, and then it formed a higher low. Higher high, higher low. Higher high, higher low. Higher high, higher low. So the market structure was in an uptrend. And what happened is, every time the market wants to continue in an uptrend, it's going to break the previous highs. That's where the other higher high emerges from. This, ideally, because this is where you can see it clearly, would be an example of a structure break. Let me just give it a nice color so you can see it. Yeah, that's a break of structure, and it's a break of structure in the market direction. So we could label that BOS. Let's make the text in pink just so that there's a difference. Okay, so you can see that that's a break of structure to continue the uptrend. Right here, we had another break of structure in the same direction, so we could tag that BOS. And then this continued. This was the same behavior. This was a consistent market behavior for a while, and we had another break of structure. Actually, we had another one too. There's a last break of structure right here. Don't need this line. Okay, so when we're in a bullish market and the trend is upwards, and you're observing the market break structure in that direction, upwards, and then something like this happens. Yeah, let's see if we can zoom in just a bit more. You see this last structure break, it came from this structural low. So you can see after that last structure break, we had another structure break. Remember, we're in an uptrend. So as much as we're in an uptrend, we've experienced a break of a low. That's contrary to the character of an uptrend, the way we described it. So that's a special case of a break of structure because of the situation. You have to build a narrative around it. So the situation of an uptrend, when we have a break that's happening downwards, yeah, that's a break of structure. That's a change of character. So we can call that a change of character. Well, I guess I'm done. I guess this is it. Because basically you can see after the change of character, you observe the market direction has shifted. And if you're thinking that the market direction has shifted and the composite man has large interest in shorting, because this kind of movement in the charts, it's not a retail price movement. This is a lot of money coming into the markets and shorting. So you'd experience more shorting probably as a follow through to this initial shorting. So you can see this is what played out continuously after that, and we didn't even break the last high that was made. So yeah, this structure break, it's characterized when you have a market that forms, like in this bullish market, if you want to observe for a bearish reversal, will form a higher high followed by a lower low. This price leg from this high to this low, this price leg is quite important. Let me just make it a different color so it stands out. Yep. I'll just make it yellow. So that price leg, it's of relevance. When you're thinking about the markets moving in a particular direction, you should be thinking in terms of a dealing frame. You should be having a reference point which is a dealing frame, or a dealing range rather. So when the market was trending upwards, we can see from this point, the new market range that was significant to you was the range from that low it had formed and the present high when it was breaking structures. So you were looking at, for example, when you started off the rally at the bottom, this high, that was your dealing range when you were at this point in the market. Even the retracements down, this was still your dealing range. When you got to this high, this was your new dealing range. So as much as you were pulling back, this was the dealing range you were dealing with. When you had a new structure break and this was your high, this was your dealing range. So when you get to a certain point, like here in the markets where you have a structure break, you're going to change your frame of reference. You're going to have a new dealing range. And this new tiny structure break, that's going to be your dealing range. Okay, so another concept that you have to tie into this, just so that you can really narrow down and get better risk parameters for your trade, because currently we can analyze like the risk parameters you probably have. You experience a structure break, and you'd probably be like, yeah, the structure is broken, and I'd probably want to get in. So you'd probably wait for the candle to close, and on the next candle you'd want to get in. Yeah, this is where your stop would be placed, and maybe you'd have a target somewhere within like the previous dealing range, like some liquidity within the dealing range. For example, look at this. This is a nice lows. This could be a nice place to target. So maybe you place your targets in this level. Over time, yeah, the setup panned out. You can see the setup panned out, but the risk to reward ratio is 1:1. That's probably not an ideal risk to reward ratio, because if you're risking maybe 3% of your account, you'd only make a 3% profit. And ideally, this means that if you're a 50-50 trader, that means you're right half of the time, which is quite rare. It's really hard for you to be right even half of the time as a trader. But if you're right half the time and you're trading 1:1, that's your risk reward ratio. That's an alarm. It's a market kill zone. This is an alarm that tells me that the London session has been 3 hours in. So there's a kill zone right now. It's actually an ideal time to look for entries in some of the currencies. Okay, so the risk reward, you can see this is a 1:1 risk reward setup. And as long as you have a 1:1 risk reward setup, even if you're winning 50% of your trades, you're only going to be break even. You're not going to make any profits. And most traders don't even get up to 50% of a win rate. It's just that you find that their setups probably have a higher reward. Let's say if you had a higher target and this was a reward, for example, that's a better risk reward. It's a 1:2.2. That's a better risk reward. And over time, if this was your system and you're trading this kind of risk reward, you'd have accumulated profits with a 50% win rate. So yeah, let's go back to our setup. Yeah, this is setup, the 1:1 risk reward. So this setup, yeah, technically it panned out. It panned out in your favor, but then you're still a tad greedy. Or rather, the fact that you knew this information beforehand and you could probably capitalize on this fact that you saw a structure break, you probably want to milk more. So you probably want to get a better entry. You probably want to crunch this number such that your risk reward is giving you better profits. So how would you do that? You're going to first trade within your dealing reference. And when the dealing reference has changed because of this structure break, and you have a new smaller dealing reference, what you apply to this dealing reference is the basic idea. I think we talked about this in the previous live. We talked about the premium and discount pricing. So basically, let's just get some white space and talk about that. If we have markets moving in a direction, let's say it's the uptrend. Oh my, it's white too, sorry. Let's give it a color. Yeah, okay, delete that. Like in the case of the uptrend, for example, we had this kind of structure. And now we've broken one of those lows that was referencing the uptrend, and this is the market we're experiencing. So this is what we want to talk about. So you can see at the point when this was your dealing reference, rather at the point when this was the only range, there, up to that high. At this point in time, this was your dealing reference, yeah? You would have to wait for price. For example, if you had already identified that it's a bullish market and you were looking for buys, so you'd be looking for continuations to buy. You'd probably want the market to come down into a discount of this price range for you to continue your buys. So here I'm going to use a fib, and yeah, up to that high. So this is the 50% here. So essentially, yeah, let me just get rid of that and these two. you would want to be trading within the discount of this range, because you want to buy at premium. I mean, you want to buy at discount and you want to sell at premium. So you had to wait for price to retrace down into the discount region for you to buy. In the next dealing frame, yeah, because when we priced from this low to this new high, we had some sort of new dealing frame, right? You'd also apply the same principle. You'd want the price to retrace down to minimum the 50%. That's the equilibrium. You'd want the price to be below equilibrium for you to be purchasing again, because you're still waiting for the buys to extend. So same principle. You can see the 50% was right around there. And then to your third, market range, you probably apply the same thing. The 50% would probably land somewhere here. Yeah, and basically, I think you get the point. So when you have this structure break, right here, the market from this high to this low, that becomes your new dealing frame. So if this is what you're using as a frame of reference, now you're going to be in a sell model because you've had a break of structure. So let's just say this is the change of character. Therefore, you want to sell. It's a seller's market. Let me just put that below it. Yeah, perfect. So you're going to look at this last price range, and we can use a fib. And this time you'll notice I'll put the fib on from the top to the bottom, but I'm just using the fib to measure out the 50%. So this is the equilibrium level. So above this equilibrium, this is premium. Below, this is discount. If you're in a seller's market, you want the price to trade up into premium for you to be a seller. That's when you're getting a bang for your buck. That's when you're actually getting your money's worth. You don't want to sell at low prices and you want to buy back later when it's higher. You're going to be making losses. So in this price range, you can see the price range, the new dealing frame, yeah? If you apply the same principle, you actually don't need a fib for this. The idea of the fib is just for you to get the exact equilibrium, but if you train your eyes to look at the charts and if you keep doing like back tests and forward tests, you keep trading over time, your eyes will just be trained to understand where the equilibrium of any price reference is. So if we look at this, here is where the 50% is. So that's the equilibrium. I don't know if you can see this line. Let me give it a bold color. Black. Yeah. Okay, so with that in mind, you can fix your risk to reward of your setup. So this means that you'll be entering when the price is above equilibrium. There. So yeah, you've crunched some numbers. Now we have a 1:2.5 risk reward setup. That's a better risk reward setup because every 3% that you'll be making would result in 3 plus 3 plus 1.5. Yeah, math is hard. Yeah, you're gonna get at least 7% on your trade. So if you're risking 3% per trade, you'd be up 7%. So that's some number crunching, but then I feel like we can still get into the fractals of this market. In essence, this market that we've observed here, this rotation point that we've observed here, can still offer us more data that will push us closer and closer to an edge. So one of the elements that I'd consider is this high, for example. you can see that there's another high that formed here. And before this high was formed, this short-term trend going up is technically an uptrend. This is a weekly time frame. So you can imagine this is 1, 2, 3, 4, 5, 6. This is 6 weeks of prices trading higher. This is quite an uptrend. This, you can be profitable in this uptrend, just waiting for the move to the equilibrium. But this being an uptrend means that the market will produce for us another high and another break of structure to give us another downtrend within this region. So this is where we want to get into. This is the nitty-gritty. So we'd need to step down a time frame. Let me see the. Yeah, kind of have to exit this to change my time frame. Whoa. What's that lag? Okay, so I've gone down a time frame and now I'm in a day chart. So we want to single out, here it is, yeah, we really marked it. So here's the structure break that we've been studying. Markets were in an uptrend, they went up, and you can see from this low right here, you can mark that as a low, and it was a higher low since it was in an uptrend, yeah? Right there. And then here we formed a higher high. So that's a higher high. And after that, we formed a lower low right here. Let me just label that. Lower low. So this is our new dealing reference. You remember that? Price came up above equilibrium. That's what we wanted to observe. And then at the same time, right here, we formed a high. And this was the highest high because in this uptrend we had, let me just copy this. We had a structure break right from down here. We had another structure break right here. We had another structure break right there. And we had the last structure break right here. After this last structure break, what did we observe? Price came and debased the last low that caused the last structure break. This debasement is our change of character, just like the previous one we saw. So let me copy that church line, that's a change of character. And I'd put it on this low, right there. So when price broke that low, that's right there, there was a change of character. Let me widen this just so you can see more detail. Yeah, actually let me just full screen this. Okay, so we've observed a market fractal in that we've seen this happen in a higher time frame and it happened again in a lower time frame. So the fact that this happened here and then it repeats inside here within itself, that's a fractal. So taking this into consideration, if you were trading on this day and you saw price come up into equilibrium, and when price is in equilibrium and it's still in an uptrend, you can't just begin to short. You won't obviously just short above equilibrium because you've decided that's what the market's gonna do. That's imposing your will in the market, and you'll likely be wrong quite often. So you'd want to wait for a confirmation. And the confirmation would be the same as how you identified that it's a seller's market. So you'd have to wait for a structure break that changes character. A structure break that's against the trend. So when you have this change of character, now is when you can think about implementing your short idea. And now your risk framework has been shrunk even more, because this will be your new dealing range. Let's just mark it out. From this high to just below the change of character, that would be your new dealing range. This dictates that your stop, this stop loss you put all the way up here, it's gonna come back and it's gonna be down here. That's your stop level. And for your entry, it's going to be above equilibrium. So I'm gonna use the fib again, just to get the exact 50%. And this is 50%, I'm gonna use the old line we had. So let me just move it. And that's the 50% right there. So yeah, our entry would have moved up just a little bit more. That's it. So let's see how much we've crunched our numbers. Let's see how much risk reward the setup is giving us now. Keep that there. Yeah, now we have a 1:7 risk reward. Remember, initially the risk reward was 1:1. So if you are trading on a 3% risk per trade, you'd only be getting 3% for your profitable trade. And it was off the same setup, you're observing, and this is what you could see. But now, your same 3%, you're gonna multiply it by 7, because your risk reward, as you can see here, it's 1:7. The risk reward ratio here says 7.7, meaning that the amount that you risk up here and the profit, yeah, this is 7 times. This is 7 times the amount you risk. So if you're gonna risk 3% of your account here, what you're gonna squeeze inside your profits is 7 times 3% of your account. So technically, this trade would have made you 21%. So yeah, way to crunch some numbers. But still, when you look at this market structure and the fact that we are trading in a day chart, meaning that the market, we can get into ever smaller setups. We can actually crunch the numbers some more. You could be satisfied with that kind of risk reward. That's actually exceptional risk reward. You don't wake up every day and get a 1:7 risk reward setup. But you could still further impose your will on the market here and get a smaller stop loss. So in this example, like right here, I'd want us to shrink down another time frame. Okay, so now we're in the 4-hour time frame. Let's just find the setup. Yeah, here is the second structure break. So as you can remember, here's the first structure break. This is the first break of structure that we observed, and told us that we're in a seller's market, and we waited for price to come into the equilibrium of that, and that's where our short idea was at. Then when we're crunching down the numbers, we decided that we'll wait for another indication that the market wants to go lower. So we waited for another structure break within that framework, like after the price has reached equilibrium, let it form a structure break. So after observing that structure break, we crunched our numbers because we got a better setup. Now, looking into this price range, or rather the new dealing reference, there's and you could get really tactical about how you're taking your entries. So, because of the behavior of liquidity, when markets make new highs, when markets sweep highs, and you're anticipating sells, for example, you're in a seller's market, and phenomena like this happens. The market comes into the equilibrium because let me just zoom out and see if I can get this all in the screen. Okay, let's measure this out. You can see the 0.5, that's the equilibrium. Yeah, so when price was above equilibrium, let's move this back so we can get surgical with it. When price was above equilibrium, you as a seller, because you've seen this structure break, you'd be looking for price to form higher highs and fail. So essentially, even if you came in and had a short trade right here, let's just move this right after this, because you were in equilibrium and the market had a high, you'd probably want to short this. And you'd short it because you've seen that happen. You'd have seen the price form a high and it started to break down. But look what happens in the future. You get stopped out. Yeah, because it's hard. You can't actually tell, and majority of times, the price is going to do this a couple of times. This is the behavior of a stop run. The price is going to have a stop run form within your premium pricing for your sales a couple of times, and it might stop you out even on your last entries. This is why I'd advise anyone who's trying to have a risk entry to just have your stop loss above the dealing frame, the bigger dealing frame. But when you have a smaller dealing frame formed, you'd have to change. You can change your points of reference and you'll be dealing with a smaller frame. So still within this smaller dealing frame, which is what I want to break down. We have market behavior that went over quite a period of time, because this is a 4-hour chart, and this was the 20th of May 21, and this was 20th of June 21. So this is probably more than a month. Yeah, right before this structure break, when this market was trending upwards, in a micro level, you can say you are having an upward trending market. Let me just copy the POS so I can show you this. If you're trading in an even smaller time frame, this would have been you buying up these rallies from this low to this high. So that would have been a structure break, that's one, and then you'd have a second structure break right there. I hope you can see that structure break here. So prices came up, they formed the highest high. Prices came down, didn't form any other high, so they remained within this dealing range. And then what happened? Prices dropped, and here it's quite nuanced, because when you observe this, you can see here there's a candle wick, and here there's a body. But then there's a body that closes technically around to below this low. So for me, I'd take it as this low has been challenged, especially since when you take out the wicks, the body has been surpassed. You can see that this low of the body of this low breaks the body of this previous low. So ideally, I'd consider that a change of character. So I'd have a change of character right here. You remember the framework? When you have a change of character, you have a new dealing reference. So we can use this same stick because we're crunching the same piece of rally. Yeah, we can have this as our new dealing range. With this new dealing range, what you do is you get the equilibrium and premium pricing. So let's do that. This is the 50%. Oh, I forgot I had a line. Let me just use the handy line we had right here. Yeah, 50% is right here. So markets trading above that would give you a premium, and that would be good for your shorts. So where was our trade? I have to zoom out now. Yeah, here it is. Now we can move our entry even higher. Okay. So that would have been the entry that we crunch out. And that would give us, let's check the risk reward. Now we're at a 1:14. That slight change in your entry technique and that slight crunching of numbers, it's given us a space to double the risk reward. So from the 1:7 risk reward, now you have 1:14 risk reward. So technically, you'd be making 42% on a 3% risk on this trade, just because you crunch numbers. Yeah, you may want to ask, can you still further crunch numbers and get a more ideal setup? Well, yeah, it's possible, but when you're hunting for entries and you keep minimizing and getting into lower time frames, trying to get that one sniper entry, you're probably going to spend a lot of time getting your stop loss hit. And actually, it's way relaxing. It's way more relaxing if you're trading with your stop all the way in the air, and the market's gonna pan out in direction, and whatever behavior that's happening here, it will become noise to you. Because if you just traded a sell and you just have to wait for all this to show up, and your frame of reference is this high, so if it passes this high is when you'll be out of the trade. You wouldn't have much tension or much pressure trying to look at microstructure that's probably changing by the minute just for you to manage your trade. You'd probably be more relaxed. But if you want to crunch numbers, you'd probably be more in the framework of a day trader. So assume you're that day trader and you're trying to crunch the best risk reward setup that the market could ever offer. So that would probably dictate that you go down another time frame. How would you approach this? Let's see. So let me just mark up the date. That's 24th of May, 21. I want to go into let's see if I can change the time frame here. Nope. I want to go into a lower time frame. Let's go into a lower time frame. Okay, so this is a 1 hour time frame. Let's just find our setup. Yeah, this is what our setup is. Here we are. So remember this little uptrend we had from the 21st of May up to the 26th of May. Let me just full screen this. Yeah, so this is full screen. This was the change of character that we had. Yeah, this is where we saw that the market has probably, and like right here, I like this time frame. There's a low right here, and that low could work as our change of character, and that would be the level. And that's what you observed. You saw the structure break, equilibrium pricing, price went lower. So now you were here and you were looking to crunch a more solid setup, right? You'd probably be looking at these tops. And there's a few ways we can go about it. One way that's become obvious to me, on this way up, we can see there was this structure break here. And this last price spike that caused the structure break, let me just zoom in so I can show you this. This is a nuance in the market. You can say that the markets get elusive when you're thinking about concepts like smart money because of stuff like this. You see this? That piece of structure there. That's a low. Yeah, that's a low, and there's a break of structure right there. If you go into a lower time frame, that's what it will look like. But at this time frame, it looks like a candle wick that's overextended and another body that just breaks through it. But that's a low. That's a low that's just been priced in right there. So you'll be observing your price in your bigger equilibrium and you watching a break of structure upwards, and right after that break of structure, you see this. Yeah, the break of structure upwards, then you see this. That's a change of character. So we'd have this. All the way up here. So at this moment, you probably wouldn't expect price to break above these highs. You'd want price to go lower without breaking above these highs, but you'd want to short from the equilibrium. So this new rally down extended till here. So when we're measuring out for equilibrium, we're gonna measure this entire price run. And this is where the equilibrium is. Remember, this was our equilibrium line, so we're gonna move it up to that level. So for you, during this period, when the market came down to this point, you'd wait for the price to reach equilibrium and you would place your shorts at equilibrium for downward price move. So let's look at the numbers. Let's see what risk reward setup it gave us. We have to move so much because like it's way off on the screen. Yeah, that's our new entry. So you can see this. The risk reward ratio is 1:26. So remember the initial target that you had down there, and the initial setup that you crunched, and you had a 1:1 risk reward setup. So your 3% risk will yield your 3% profit. Now you're up to 26. So if you're doing 26, you're getting more than 75% profit. This is basically you running a double. This would be one trade, and throughout the lifetime of this trade, you'd probably double your equity. So yeah, that's impressive. That's impressive because you have your stops around here. Actually, I didn't even move the stop, so I guess we could probably get a more refined number. Let's entertain ourselves and see what number we could get. Let me add a new stop. Pretty much the same. But now to emphasize the point of the fractals even further, do you think that's like the end? Do you think like that could be the end of us trying to crunch the numbers for a setup? Or we could achieve a more stringent setup with like tighter risk to reward, more reward, if we crunch the numbers some more. So even just by looking at this chart and this last high that we formed, this was the last high before the beginning of the entire rally down. When you look at these candles right here, coming up to this high, to this low and this high, there's some interesting price action occurring within here. So we'd probably want to go down a time frame and see if we can crunch the numbers a bit more. So let me highlight the region so that when we go down the time frame, we can easily find the region. But we know the date